figured you'd be interested in that. I keep looking at that thing. In fact, I was looking at it yesterday, on the report that you. Something, something.
Thank you. All right, Rick Hensley.
No, I'm counting. Zane ain't made it yet.
Zane's fishing, probably. Thank you. Yeah, I've seen your name a lot, Jeff.
Okay, we'll call this meeting to order.
Jeff, or just?
Gentlemen, and let's see, I got a number of items there to get us started, so want to acknowledge our retired officers, and we will have a new city manager who is just walked in with us, so Josh
City
Potter.
attorney.
City attorney, excuse me. And we have a new trust officer as well, Ryan Pierce. And Ryan provided his cards to you, and Jeff's back with us as well. Thank you all for being here. We'll have our opening prayer by Captain Sewell.
All right. Praise Heavenly Father, we're thankful for your many blessings. We ask, Lord, that you'll be with us this morning and give us wisdom and guidance as we handle the business of pensions and people whose lives are affected by it. We ask this thing, Lord, in your name, and we'll give you the praise and glory forever. Amen.
Amen.
And we're welcome back to the board, Captain, too,
Thank
as
you,
well. So, let's call our roll call there, please.
I'll do your roll call.
Yeah.
Jay Ellington is present, Tyrone Henderson present, Calvin Seward is present, Glenn Greenwell, he is absent, Zane Gray is absent, Rick Inslee is present, Ernie Keck is present. We do have a quorum.
Ma'am. And Rhonda, if you'll start with item 2 for us, and give us some.
Yes, sir. So the city puts in additional revenue into our old police pension plan. That revenue consists of property tax millage, mixed drinks taxes, fines and forfeitures, probation fees, and our general fund contribution of $100,000. For year-end 2022, the city contributed approximately $624,000 into the old police pension plan.
624,
Yes, sir.
that's the contribution for the year.
Yes, 624,000.
Okay. I need a motion to accept and approve this item.
Make a motion to accept.
Okay, second.
Second.
Any discussion? All in favor, say aye.
Aye.
Any opposed? Motion passes. So this is concerning our election and our re-election, in some cases, of our board members. And make sure you have your interest and into Glenn for a May 23rd ballot to continue or not continue in that role, okay? So all our action there is to make sure that we've given everybody notice of that, and anyone interested in running sends that to Glenn,
Make a motion to approve that.
okay? Motion, second.
Second.
All in favor, say aye.
Aye.
Okay, item passed. Item number 4 is our Bank OZK review, and with our new trust officer and our former support person, So we'll turn this time period over to y'all.
Thank you, Mr. Chairman. For those that don't remember, my name is Jeff Dixon. I'm with Banco ZK. I'm the Senior Vice President in charge of retirement plans for Banco ZK. I've been there since April of 2020. Came on right in the middle of the dreaded pandemic. But just want to talk a little bit about your performance of your plan and how the plan's done in the last year. Everybody should have a packet of materials that was handed out.
We need two.
Sir.
Okay, I guess before we get into the materials, one thing I just wanted to say is our longstanding portfolio manager with respect to this plan, the Chief Investment Officer for Banco ZK, was named Minnie Mills. Minnie retired a month ago, and she took a very well-deserved retirement. She's been working for this plan and many other plans with respect to Banco ZK for a number of years and provided tremendous service over those years. And I wish she could have been able to be here for our last meeting, but she finished early this month. She retired on, I think, March 3rd, I believe it was. But we're proud to welcome our newest investment officer with respect to this plan. His name is Ryder Pierce, and Ryder's going to cover the portfolio discussion in a minute, but I just wanted to go ahead and introduce him now and just say that Minnie sends her regrets not being able to be here, but she did say that it has been an absolute pleasure to serve this board over the years. Okay, let's go ahead and get started. First of all, we've got the first few pages are just the team that represents your plan. There's my picture and my contact information, a little information about my history, and then there's information about Ryder. Ryder has been with us. He came end of December last year. It said early this year, but actually he's been here since December of last year. Before that, he was the investment officer with respect to a bank in East Texas, where he handled a large portfolio, and he'll give you more information about all that he's done when he makes his presentation. And also, many of you may work with my assistant, Angie Mobley. She does a lot of work with respect to this plan and handles the distributions and also deals with a lot of former plan members with respect to the system. Okay, so if there are any questions about the team members, just let me know. Y'all know who we are and where we are. There's been a lot in the news lately about banks, and I'm here to tell you that Banco ZK is one of the best capitalized, if not the best capitalized bank in the country. In fact, according to one publication, it is the best capitalized bank in the country, S&P Global Market Intelligence. We do not, Banco ZK has been very conservative and intelligent in its investments. They have not tied up long-term investments in low rates, and they've focused on stable, strong, good lending practices and good investment practices. Just a little information about Banco ZK. Banco ZK is a nationally recognized industry leader in financial services. We focus on relationships, expertise, and excellence. Just as of the end of last year, we had $27.66 billion in assets, $21.5 billion in deposits, and $20.78 billion in loans. The total combined stockholders' equity for the bank is $4.35 billion, and the net income for fiscal 22 was $547.5 million. We offer a number of services, including Trust and Wealth, which is the service that handles your plan. Just some of the next page has some of the publications that have recognized Banco ZK and the stability that we have provided over the years. And I put this on one page because it's so important with what we're dealing with right now with banks in the news. Banco ZK is the #1 capitalized major bank in the U.S. based on S&P Global Market Intelligence data as of December 31, 2022. Now, with respect to your plan, in the past year, we have handled payments for totaling $82,795.31. We've done health insurance withholding of $780.12, and we've dealt with 34 participant or members of the system. So unless anybody has any questions, I'm going to go ahead and turn it over to Ryder and let him talk a little bit about the portfolio performance and the economy in general.
Thanks, Jeff, and thank all of you for having me today. I understand that I'm filling very, very large shoes in many mills, and as I shared with some of you, had the pleasure of working with Minnie for 3 months. She, to make a long story short, I had our house sold, and we were moving to Tyler, Texas in early December. And I'd taken a larger role where I was running investment portfolios for an $8 billion bank based out of Tyler. And Minnie called me the week before Thanksgiving, and she said, hey, how would you like to come back home? I said, well, I'm from Mountain Home, Arkansas, and I have 2 little ones. And we just had a new baby, and we're feeling kind of homesick. My parents hadn't seen him yet. I said, well, Minnie, the good news is in three weeks my house closes, so I can go anywhere in the world. The bad news is I have 3 weeks. So, and my wife I think she called me, my son was 3 weeks old, our second son. And so I said, my wife is going to want to know him too. So they were great at expediting, and 3 weeks later, I was a Bank OZK employee. 4 weeks, I guess. There was a 1 week lag. We got a rental house in Little Rock with 4 days to spare. So, we're just happy to be on board and had the pleasure to work with Minnie and be a part of those client appointments where I saw firsthand the good work that she had done. And so I'm going to handle things probably a little bit different than she will. Just based on our presentation style. So I ask you to please be patient at any time if you have a question for me. We're here to provide information and to serve you. So don't feel hesitant at all to ask. If you want to ask anything about the banks, and all of you, unless you've been living under a rock the past week, have seen everything in the banking environment going on. I can expound on that as much as you would like towards the end of the presentation. I have an opinion on it, but I'll stray from talking about Bank OZK for liability reasons. That being said, I'm going to review an economic environment, backward looking. Anything we discuss is going to be. Thing about investments is data is history-based, but decisions are forward-looking. Since this is an annual meeting, these are going to be end of December 2022 numbers and economic data. Rachel, will you please? Thank you. So first, we'll just take a look. We're going to take a look at the economy, the unemployment environment. We're going to look at the real estate environment, the dollar. We're going to look at treasuries in the interest rate environment, and then we'll look at market returns historically. So the U.S. economy has proven to continue to be, as many would say, the best house on a bad block, where we have outperformed international economies with our flexibility in our monetary policy standards, as well as fiscal policy. Now, GDP growth continues to be below trend growth, which is 2% average back to, we'll say, 2001, according to the chart. We do expect that, and most economists expect that to stay under trend growth given the swift rise in interest rates. On the right there on that page, you can see how, I'm going to stand up. Will that be all right? So on the right here, we show components of GDP. I think the important thing about this slide, and this is a 40-slide deck that one of our economists put together, but I've limited it to 15 slides for the sake of time. Consumption still makes up 68.2% of our GDP, which essentially what I want to hammer home there is any growth or recessions that happen in the United States, they start with the U.S. consumer, and they start at the bottom and they trickle up. And I think a lot of people sometimes forget that, definitely business owners and such, that consumption is the primary piece of our GDP. Furthermore, net exports, we continue to import more than we export, and that's a trade balance discussion. Can you move on to the next slide? Thank you. Now we're looking at unemployment. Unemployment has been historically low in the likes we've not seen since going back early 70s. It is a very unique characteristic. It speaks to the Fed deciding to leave interest rates low for a long period of time. I know we can say whether or not that was a good decision, but there were so many uncertainties in COVID that the Fed did what they thought they had to do. We have seen a spike in wage growth, thankfully, to combat inflation a little bit, but that has shown a slowing. That slowing in wage growth has continued into 2023, because I know these are backward-looking numbers. Rachel, please. Housing. So housing is the other major discussion, the major topic that has been on any news article or any major news provider. What's been interesting is we understand that the present value of an asset is the discounted future cash flows expected from that asset. Now, the issue with that is the denominator in that formula is the interest rate. So the interest rate determines the present value of assets. That interest rate has changed dramatically. We have not seen housing prices change to reflect that. We do not know if they will. That's a huge tug and pull among real estate economists right now. So say the interest rate on a house goes up 1%. If you have a 20% down payment at current rates, that means the amount of house you can buy goes down by 8 to 10%. And I know many of you are sitting here saying, hey, I bought houses at 13%, but a lot of that, the correlation between as rates go down, prices go up. There's historically a negative correlation between housing prices and interest rates that we're seeing kind of claw back a little bit. And it's been interesting to see how those dynamics have changed, coming from someone who sold a house in December and is hanging out in a rental, wondering what the future is going to look like for the U.S. housing market. You can see right here, national home price year-over-year change. These are October numbers. It started to dip a little bit, 9.2%. What makes this different than 2008, 2007, 2009 is that the credit score of borrowers is up significantly. So thanks to some of the laws and regulations put into place outside of the Great Recession, we're seeing a higher credit quality borrower. Furthermore, housing affordability, which is a relationship between median home prices and median income, is at its lowest measure in 40 years. Housing inventories have really driven that. We see in the top left corner, housing inventories are at its lowest level in 40 years. A lot of that you can see on the bottom right corner top right corner, is that the housing starts coming out of 08-09 are causing the supply and demand issue you're reading about on the news, where there's just not enough houses for sale for American families right now. Next slide, please. Another thing I want to talk about today is the dollar. How does that affect you? Not too much here domestically, but it does affect our businesses that buy international. So interest rate parity says that as rates go up in the United States, or we'll say when rates go up in a country, the demand for their deposits to get higher rates goes up. That drives that currency up. So we see a situation where the developed market interest rate differentials between the U.S. and international are at, well, they were up in 17, 18, but really we've not seen this differential since back in the late 90s, and that's driven the dollar up, though it started to dip the past couple weeks. It is something to pay attention to, because it really affects our trade balances with other countries. And then oil, and it's funny living in East Texas, who, our economy, living in Lufkin for years, and then working out of Tyler, where that economy is so based around oil, I never thought we would have seen a situation where oil futures were trading at negative $40 a barrel. But that happened back in 2020. Oil prices have been highly volatile, though we're kind of used to that at this point. The U.S. continues oil production at a level of increasing at 8.2%, while consumption, let me get my numbers right here. Increasing over the past 5 years, growth since 2019 at 8.2% annualized, while consumption is down 0.1%. So we have seen a little bit of relief at the pump the past going into this year. I know if you commute to work, that's been a breath of fresh air. Go ahead, please. And this is as we get into the meat and potatoes, as we turn the page one more time, U.S. Treasury rates are the most important thing to pay attention to. So what has happened is essentially the Fed claimed that inflation was transitory. It is proven to not be transitory. That inflation has inherently been sticky, and even inflation data came out yesterday, and it was up 0.5%, and that's an annualized, up, I guess 0.4%, but that's annualized somewhere around 5 to 5.1% for price increases, even headed into an increasing interest rate environment. You see this line right here? These were interest rates 1 year ago. Those were interest rates at the end of 2022. We have not, and I want to emphasize when I say this, we have not in the history of our Federal Reserve seen interest rates increase at the velocity that they have increased in 2022 and headed into early 2023, which heads back to that conversation of current asset values are purely a function of their discounted cash flows. When I say discounted, I mean divided by the interest rate. Well, that interest rate has gotten quite a bit bigger in over a year, but it feels like overnight. That's led into the situation that we're currently seeing with banks failing, where banks have these large securities, where when banks get deposits, they have two options with what they really do with that money. They either loan it to businesses or individuals, we all know that, or they invest it in securities, hold it in cash. And what a lot of banks did in 2020, 2021 is they were stretching for yield, and the only place to get it was to go out a few more years in maturity, just go out a few more years. And so what they were finding is, we're only getting 1.5% on a 10-year treasury or 1.25% on a 5-year. We can go out just a little more and get 2. And to them, that's huge. Well, what it essentially was it was a bet against inflation. It was a bet for transitory inflation, because if inflation wasn't transitory, then the Fed was going to have to raise interest rates in a way that they have. Now, there's a measure called duration. That is the price, the relationship between an interest rate and the price of these securities, these bonds that banks were buying. And I say banks, not all banks, but some banks. And that's where you see definitely like a Silicon Valley Bank, which is all over the news in the past week. They went out and bought all these long-dated bonds. Rates spiked. Those bonds fell in price by 20%, give or take. Just estimate numbers there. Well, what did they do? Instead of claiming those losses, they took those bonds and took them from available for sale, and they just reclassified them. An accounting trick, essentially. They reclassified them to held to maturity. So those losses no longer have to flow through to the income statement. They can hold that bond at par on its balance sheet until it matures. That's fine if you can hold that bond. But if you get into a liquidity crunch and you have to sell that bond, you have to sell that bond at a massive loss. And I think, what are they, 20 billion in losses that they took? No, they sold 20 billion in bonds to feed liquidity and took over 2 billion in losses on that 20 billion. And that's where they ran into the situation. So, there are a lot of banks out there that are much better capitalized, that did not make these long interest rate bets, that they have short-term liquidity So I've kind of bounced from treasury rates into that. What this is effectively changed bond portfolios, including in your pension or in retirement accounts. It's been a very interesting period in 2022 where bonds were down 13%. We'll take a look at that slide here in a sec. Go ahead and I've kind of rambled on interest rates, and I didn't mean to. All right, so this is the Bloomberg U.S. Aggregate Bond Index. These are annual returns. If you see 2022 was absolutely as bad as it felt, and that's what made this situation so unique. It wasn't the stock market being down. We all understand that we've been through, many in this room, through 2008, 2009, and then through the COVID drop. We understand that stocks go up and stocks go down, and that in the long term, the best thing to do is to hold for your investment goals. Now, in this case, bonds fell 13%, down 17% intra-year, and that is because the Federal Reserve raised interest rates so fast that the bonds that were issued were priced, the rates were so cheap, the prices were so high that they just got crushed. And that's the situation we're in now. I will reiterate that if you had prudent financial decisions made by your investment advisor where bonds were bought at par value, they will mature at par value. And anything that happens between then, please do not get caught up in your goals of those individual fixed income securities, which is to earn income between the time that it was bought and the time that it matures, and what happens between point A and point B should not matter. So that's it's been a very go ahead. It's been very unique in that sense. This is the S&P 500 annual intra-year declines. So it does average, the S&P 500 averages an intra-year decline of around 14% per year. That's a really interesting fact because that means every year on average the S&P is down somewhere within that year at 14%, which continues to reiterate our claim that the best thing to do is not make reactionary decisions in your investment portfolio. Sometimes things are high and sometimes they're really, really low on a price value basis. And at the end of the day, the best thing you can do is hold to your investment goals. So this is a breakdown of asset class categories and styles. You have large cap, mid cap, small cap, value, blend, growth. This I can kind of tie into our current investment strategy a little bit. Typically growth is more interest rate sensitive, which the difference between growth, blend, and value. Growth are going to be companies that they take their net income, they reinvest in projects. Value is going to be companies, they take a portion of net income, they pay back that portion of net income in dividend. We are currently a little bit overweight in value relative to other categories and or styles. Now, the interesting thing is small cap is typically one of the best performing sectors. If we did this a year ago, small cap would be on par with the rest, but it's been crushed so bad because of the rising rate environment where small caps now the least performing place to be over the past 10 years. Otherwise, no, that's good. Otherwise, in 2022, the best place to be was going to be those large cap dividend paying companies. I'd say companies you all in the room were born and raised with, and companies my son was born and raised with. You can see more on the value. Go ahead. We can go ahead and skip through this, Rachel. We don't need to talk on value and growth. We can skip corporate profits. I want to get to asset class returns right here. This is your classic, some people have called this a jelly bean chart. The importance of this chart is that if you were to pick a color, say you picked a gray and you tracked gray from 2008 to 2022, it'd be up. It'd be down, you track back and forth. If you picked blue in the top left corner, which is fixed income, you'd go back and forth. But at the end of the day, a balanced portfolio is the best risk-adjusted way to invest money when it comes to both both return relative to standard deviation of returns. And you can see that right there. It makes everything in the long run just a little more smooth. And we continue to believe in our diversified process at Bank OZK. Sorry, Rachel. And finally, I think this is the last slide, right? So this is a 60% stock, 40% bond portfolio, and I just want to, because not only do we have the pension here that we invest for you, but we have, and up until December, that was many, and going forward, as of a couple weeks ago, it will be me if you choose it to be so. But this is, you all also have personal investments, I'm going to assume, either in your 401k or your IRA, and this is what has made 2022 so unique. And that's the fact that a 60-40 portfolio was down 16%. And the reason a 60-40 portfolio was down 16% was that not only were stocks down, but bonds were down 13 to 14%. And that's what, it was a unique situation where the economic environment was not near as bleak as 2008. However, because a large percentage of that portfolio is in fixed income securities that were down 13 for 14%, it felt almost as bad as 2008 in a diversified portfolio. We still believe that bonds and fixed income hold their place in a portfolio over the long run. We don't believe a black swan event means that we should have a flight from modern portfolio theory. But one thing that I ran, this would have been, I'm going to try to get my numbers right here, probably November of 2022. I ran the correlations historically, 3-year correlation between the Bloomberg Aggregate Bond Index and the S&P 500. And that would have been going back, I'm trying to think where I ran my data. It was, say, back into the late 70s, early 80s. And historically, the correlation between those two, correlation being a number from -1 to 1. -1 being perfectly negatively correlated, 1 being perfectly correlated, and 0 being absolutely uncorrelated. The correlation numbers were 0.24 historically, which means, they were not really correlated with each other if we go back 50 years. Over the past 3 years, they've been correlated 0.76, which means bonds and stocks have moved more in sync in the past 3 years than they have in the past 50 years. And that's what has made this situation so unique. We think that, we believe at Bank OZK in mean reversion, essentially, that performance will revert to the mean in the long run if you have a diversified strategy and a long-term investment perspective. So I've kind of rambled a little bit. It's hard to cover all that economic stuff. Do you guys have any questions on any of this? Because you're welcome to stop me at any time.
No, I've got a response.
Please.
I really enjoyed your presentation and the way it was displayed, that we could understand every aspect of it, about what the real issues are.
Okay, thank you.
I appreciate that.
Thank you. Well, let's look at the portfolio. Let's look at how the Texarkana Police Pension and Relief Fund have done. If we turn to, thank you for pulling it up, by the way, Rachel. I'm going to get my page here. I'm going to sit down for this, if that's okay. All right, so here we are, page 2. So when we look at performance of an investment portfolio, the most important thing is that it matches your goals. And the second most important thing is that we have benchmarks that relatively reflect your goals. And that's, I can give you performance all day long, but if I don't have a good benchmark to measure that performance against, it means nothing to you. Up 6% means nothing if you don't know what we're measuring against. If our benchmark was up 9%, then up 6% is bad, right? So right here we have those benchmarks labeled. The asset classes you are invested in, it says 0 on cash. That's because all of cash is held in money markets. So we have money markets and equivalents, taxable bonds, U.S. equities, and international equities. You can see how that breaks down right there to the right under portfolio allocation. So actually, I'll get back up because it's easiest to do. So right here, you have money markets, taxable bonds, U.S. equities, international equities. Benchmark is the money market index, the Bloomberg 1 to 5 year government credit index. Now, this is our default index for fixed income. I think it's safe to say that this is an average maturity of about 2.5. That's probably shorter than the life expectancy of the pension, but it is our default index because it is the least volatile fixed income index. Then for U.S. equities, everyone in here is probably familiar with the S&P 500, but international equities, we use the MSCI EAFE Gross Index. So currently, the current global investment environment is about 63%, give or take, based on volatility, U.S.-based, 37% international and emerging markets. We are currently overweight and have been overweight U.S. equities in this portfolio. They've outperformed, but we'll get there. And then we're looking at about 40, let's see, what's the actual breakdown there? 43%, give or take, 45% in money markets in taxable bonds. Now, on the equivalent stage of this is going to be U.S. Treasuries. Treasury bills, essentially. So those are going to get tagged on the money market. The last 3 months or the quarter ending, money markets did 0.6, the benchmark did 0.9. Taxable bonds did 0.2, we're up 0.2, the benchmark was up 1.2. U.S. equities were up 8.3, the benchmark was up 7.6. International equities were up 13.6, the benchmark was up 17.4. On an annualized basis for the year of 2022, 1 to 1.5 on money market. Taxable bonds were down 9.1%. However, the benchmark was down 5.5%. But the Bloomberg Aggregate Bond Index was down 14%. So once again, that goes, I think there's probably a classification issue on the benchmark. Typically on a benchmark where it's a 1 to 5 year government credit like your benchmark is, it's a very short-term investment philosophy. We're high on that, but we're very in line with what would be the 1 to 10 year U.S. Treasury and Agency on performance. Our U.S. equities were down 15.4%. The benchmark, the S&P was down, does that say 18.1? Thank you, 18.1. International was down 14.1. The benchmark was down 14. Furthermore, you can see since the inception of the account on the far right. So we were behind in fixed income on the 1 to 5 years of benchmark, probably matching on a 1 to 10 year or close. We were ahead of the S&P on U.S. equities and pretty much par for the course on international equities for the year. Total portfolio performance down 11.8%. The blended benchmark, which is a weighted average of all those benchmarks up there, down 11.8%. We did not cherry pick those benchmarks. It just worked out that way. And then the final piece, which is the where are we at today. It's on your final page back there. The current asset value of the account, and this it is end of day, 2 days ago, so I printed this yesterday, intraday, is $4,316,919.15. You can see how that breaks down on the final page in your packet. Let me check to make sure I did not miss anything I want to cover. Let's see here. Total gain and loss in the account since inception, that's going back January 1 of 2017. Total gain, $1,421,462. There has been $1,985,326 taken out of the account. So that is a whole lot of information at you all at once. I am here to answer any questions you may have. if we were to talk about, I've just got the account in front of us. We have many repositioned last year, fixed income really, really short. So now we are thankfully in a position where we have not only $800,000 in cash that's earning a money market rate of over 4%. We also have probably closer to 4.5% today. We also have a laddered out treasury bills coming due I'm sorry, that 800,000 is including the treasury bills because it's equivalents. So we have 800,000 coming due for either reinvestment or distribution this year. We have more money coming due next year. We're really set up to take advantage of this rising or higher rate environment. And I was not here for that decision, but these were all things that many did like middle summer to fall of last year to kind of get y'all ready to gear up for some higher rates.
Since you've looked at it this first time
Yes, sir.
for you really to analyze this, are our percentages in market value in the proper categories?
Yes, sir. I believe so.
Okay.
Your equities are managed very similar to our fund model, which is researched by both our investment committee and 5 or 6 people just like me, where I'm probably the guy that brings the averages down in the full ability of that committee. But yeah, from an equity side, we are currently having discussions about whether we want to continue underweight international going forward, because international has had pretty much a flat 10-year performance. But we're still kind of in the process of reviewing those decisions. Being underweight international has been the right move, and you've been underweight international for 6 years. So or overweight domestic. As far as fixed income, you could not probably be positioned much better going forward in your fixed income exposure, because you're going to have most of, if not all of your fixed income exposure maturing over the next 2 years, 2.5. So that's a good time to be reinvesting money relative to a couple years ago. We're having a bunch of long-term stuff that was just locked in, and we really couldn't take advantage of higher rates. This is assuming rates stay high that long. I don't want to make any interest rate assumptions. That world has been crazy.
How many of these accounts do you get to manage?
I manage roughly around 300. Total asset, give or take, assets in which I'm labeled the investment manager, around $500 million. Now, where I came from at Southside Bank, I ran $1.1 billion, including the company pension, and then had just taken over all investment duties, chaired the investment committee, and ran right around $1.6 billion before coming to Banco ZK. Started my career, 11 years ago at Edward Jones headquarters in St. Louis. Please, any more? I mean, if you have an economic question or an investment question, all this stuff is very, very, it can get complicated, right? There's not an easy way to do an economic review and it not be complicated. So
how will our increased money going in help our system? We increased from 100,000 to 125,000, the city did this year, into this pension fund.
that an annual contribution or a?
Yes, how will that yield? What will that do for us?
So right now, our goal is to fund, or your goal is a pension, is to fund obligations.
Right.
So that will continue funding obligations. I looked at it with Angie yesterday and looked at both distributions and contributions for last year, and it was pretty much a wash. You had about as much money come in. It wasn't enough that I was like, I better have those numbers on me. It was around $1 million and sent out, around $1 million came in. So really at this point, the goal of this plan is purely funding obligations. So that money will help you fund obligations better.
And there is no crossover point on this fund. is not expected to run out of money for the end of the fund. And so that's always important to bring up, is not expected to run out of money.
So I did a sustainability analysis yesterday, and then Angie brought those numbers in, and I went, oh, there's absolutely no reason, there's no reason to have this sustainability analysis. I mean, pretty much what's coming into the fund last year match what's coming out. And this is, here to take care of the good employees and police employees for the city of Texarkana.
Anything else, board members? Anybody need to ask?
If you think of something, I'm here all day, so please.
And just one last item. With respect to the minutes, the letter of certification, I sent that to Captain Greenwell this morning by email, and it was forwarded to Dave Clark at Lobby. So that's done. So it was, but just to clarify, it was me and not Ryder that signed that, as I've signed it in the past. For the,
Have you received a copy of it as well?
and that's all we have, unless there's anything else.
Thank you.
Thank you very much.
How many fish did you catch, Lee?
I didn't go today.
Okay, well,
I misread this thing.
he lives on Millwood. He's actually been a guide on Millwood, so, yeah, you might could hire him out. I've done that.
Okay, board, we need a motion to accept the Bank OZK item report.
Motion, yeah, second.
Okay, motion and second. Any discussion or? All in favor say aye.
Aye.
Any opposed? Motion accepted. Our last item today is for me to tell you that I'll be leaving as your chairman, and I think most of you probably know that, but, so, your next manager will come in and replace me in this role, whomever that might be. The board is authorized advertisement for that position. And I think their latest was out another 30 days or so, so they will get to that as quickly as they can. In the interim time period, Ms. Henderson will serve as our interim person and work toward any items that may come to the city manager's office will be on her desk to deal with. So any questions that you may have from the city side, she'll be glad to answer those for you. And if we need any action, she'll be glad to get you back together and do that as well. So, but again, it's been my pleasure to work with you, and thank you for welcoming me into this group. And hopefully I've asked a few questions that helped all of us understand where we are a little bit better. I know Jeff's had to sit through a couple of my question sessions, so and it was a real pleasure when Ernie came and talked to the budget committee this time too, because they needed to understand, the elected guys needed to understand a little bit more about where the fund is and what they could actually do to make sure that the fund is healthy. And they reacted to that, and so very positively, I think. So, and directed me to put some more money toward that. So the board knows its obligations to these funds and to all the retirees. So I tell you that because they wanted to make sure that, and they know whether the fund's always healthy or not, the city is always obligated to the retirees, okay? So they're well aware of that, and just that increase by itself kind of helped establish their ability to see that they have an obligation as well to make sure about adding additional funds to the pool. So I think that's been a good move. But I challenge you to stay in contact with our elected leaders as well as you go forward, because they may make decisions that affect this fund. But again, they understand, that group of 7 now understand their obligation and have increased their meeting of that obligation as well, too. So I share that with you. So thank you for working with me.
Thank you.
Pleasure
We've
working with
enjoyed
you.
Yeah.
Good. I don't think we have to have any action on me leaving as chairman, but let's
I mean,
see.
if we deny it, I don't guess anything will happen.
Item number 6 is a stipend payment. Receive your annually stipend payment from the Turnback Funds on or about August 23rd, a $50 stipend payment paid each month in your retirement check. Second stipend payment is paid in a lump sum each year with a built-in COLA. And this will be delivered to your checking account as we do each year. So do we need a motion to keep that in place, Tara?
No,
I
that's
think
just
that's
an
just
annual.
information item, really, so. Okay, that's all our items today. Any comments or questions from the board members?
Like to make a motion to adjourn.
All right, let's hold that just a minute.
Okay.
Let's see, how about comments from any of our retired officers or surviving spouses that may be present with us? Anybody? Any comments? Okay, thank you, sir. Okay, now we'll entertain that motion, sir.
Make a motion to adjourn.
Have a second. All in favor, say aye. Aye. We are adjourned. Thank you.
Sure glad I made it in time.